The reason gold fever is a thing is that it was an evolutionary object for ever since the first caveman pulled it out of a river and went, wow, what's this stuff? Ever since then, the caveman with the gold gets the cave girls with the gold, and it selects for gold, doesn't it? Evolutionary selection is based around gold. And even today, old chubby men like myself with a bit of gold on their wrist can attract certain attention. Or anything that's a physical metal, particularly metals, is going to go ballistic over the next, until further notice, right? Because AI is going to consume all that. Even silver, I mean, silver obviously is retail gold.
Clem Chambers argues that humanity's relationship with gold is far deeper than finance. It's embedded in our very DNA. From the earliest civilizations, gold has held a magnetic appeal, not only as a store of wealth, but as a symbol of beauty, power, and permanence. Unlike paper currencies or digital entries on a balance sheet, gold offers something tangible, scarce, and universally recognized. Its unique physical qualities, indestructibility, malleability, and luster, ensured it became the default standard of value across cultures. Chambers suggests this ancient attachment still drives behavior today, influencing how societies and individuals respond during times of uncertainty. In his analysis, Chambers highlights that when confidence in financial systems wavers, people instinctively turn back to gold, much like a reflex. This is not simply a rational calculation of risk and reward, but a deeply ingrained instinct. Unlike stocks, which can collapse, or fiat money, which can be debased, gold maintains its role as a timeless anchor. Investors often rediscover this connection during crises, whether economic meltdowns or currency shocks. The gold trade, therefore, is not just about speculation, it's about survival instincts resurfacing in modern markets. Chambers also draws attention to the cyclical nature of gold manias. Whenever gold prices surge, they tend to awaken an almost primal excitement in investors, quickly spreading beyond professionals into the mainstream. He notes that while this enthusiasm often leads to bubbles, it also reflects gold's enduring psychological power. Each new wave of gold fever reinforces the idea that the metal is not just another commodity, but a unique asset class with emotional weight. Before we dive into Clem's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think the market was saying the same thing, and I mean, you've got the Donald jumping up and down on Jay Powell and saying, cut interest rates. Oh, by the way, we're thinking of, suing you for spending too much on a building. Cut interest rates. Fire that person on the panel. Get somebody else in that agrees with me. Cut interest rates. And you got Powell going, no, we're independent. That's a long word. It means independent. We're not going to cut it now because you've just done inflationary things, Mr. Trump. Oh, sorry, President Trump. We're not going to cut that. Oh, all right, then. Have a little one. So, I mean, nothing burger. I think you summed it up. And the real big thing is go get yourself a long-term chart of the dollar and go have a look at it in terms of the yen and the pound and the euro. And you'll see it's really strong. And then go and have a look at GDP per head of the average American and the average Japanese and the average British and the average European. Which actually, if you drive around in a Tesla in all these countries, you'll notice how similar they are in terms of how they look, how they trade, how people are, how much they've got, how much they haven't got. And yet the GDP is almost double in America. Well, that's because the dollar's too high and the dollar's coming down because you can't fix your trade deficit. You can't have a re-industrialize America if the dollar's too strong. And the dollar's too strong because their business has been printing dollars. That's been the main business of America for the last 20 years. And they've got to flip it around to their main business being making things, like Germany used to do. And to do that, you need to have a dollar that's in line with other currencies, like the yen, like the euro, like the pound. That means the dollar's coming down, which means if you've got all your money, all your assets in dollars, you've got to get out of dollars and into some other currencies, haven't you? And that's really what's going on. And well, why not just stick it in gold? Oh, there goes gold. Whoosh. There goes silver. Whoosh. There goes foreign market stocks. Whoosh. Because you don't want to be in dollars when dollars are going to come down. So that's one of the reasons why the precious metals are so strong. And the other reason is gold is for war. And, they're picking fights, at least, rattling sabers all over the place now. And If you're a government, you have to stack gold because gold is the currency of conflict. And that's why it's good to move, because you can get a lot of value in a small space. So when you want to pack money into a submarine to go pay for some tanks or steel or tungsten, you want it to be heavy, don't you? Which is why you don't do it in silver. Although I don't think in the mainstream people realize just how far the dollar will come down to get back to a proper parity to the euro and to the yen. I mean, it was 100 yen to the dollar not that long ago. It's 150 now. Now, if the dollar came back to, say, 110 to the yen, then you would have a GDP parity that looked more normal per head, a GDP per head. And that's what's going to happen because, Trump wants to, well, it's not just Trump, it's the whole American state, deep state, if you want to put it that way, wants to get America back as the workshop of the world. Because if you look at history, the workshop of the world is the country that controls, that is the number one power. And right now, the workshop of the world is not America, is it? It's China. And, the workshop of Europe is Germany, or certainly was up until they cut off all the energy. And the leading power in Europe is and remains Germany, because it's still the workshop of Europe. So if you're the workshop of the world, you are the leading power of the world. And the workshop of the world is not America. Now, you could say, well, they have all the Amazons, they have all the Nvidias, they have all the Googles, they have all the Facebooks, but they're real fragile because you can just go firewall and they're gone as far as anything outside of America is concerned. So it's not like being the only people that produce ships or the only people that produce chips or the only people that produce light bulbs. By the way, I don't know if America does or can produce light bulbs anymore, but certainly 10 years ago, there wasn't one light bulb factory in America. Well, that's a fragile place to be. If your opponent makes all the light bulbs, the light's going to go out in your country if you get, in a conflict with them, aren't you? So you have to bring that back home. And you've seen that with Intel, and you're seeing that with rare earth and Mountain Pass a few weeks ago. You're seeing it with ship tax. If you unload your big container ship in an American port and that ship was made in China, they will bill you $7 million just to unload. And the point of that is, well, you better have a container ship that's built in America and you won't have that tax. So that's what's going on. That's the big thing. And that's will be one of the two things that is going to be driving everything. The global conflict between China and America, and of course, AI. Yeah, it's about machines and it's about robots and about mechanization and about highly skilled people that you make yourself, not that you bring in. I mean, actually, if you think about it, and Britain used to do this and probably still does. Oh, yes, there's all these doctors in the third world. Let's bring them here. Well, what are you doing? You're strip mining at developing countries of the highly skilled people. That's the opposite of foreign aid, isn't it? That's like taking all the most valuable people and kidnapping them. I mean, that's an awful thing. Awful thing. So, I've never been a fan of that idea that you should take all these developing nations and strip them of their skilled people and bring them to your country because that's a good thing. Well, it's not really, is it? It's really, really unethical when you think about it. But what is it going to? There's not enough workers. Oh, let's have more people. Then, let's have more people. Let's have more people. Let's have more. When does it end? When the Earth's a cinder, a smouldering boulder with people stacked on people? No, that's not the answer. Never has been the answer. Population isn't the answer. Science and mechanization is the answer, and there's a lot of that coming.
In today's financial environment, Clem Chambers underscores that the old patterns surrounding gold are once again asserting themselves with full force. Governments around the world are burdened with rising debt loads, central banks are juggling inflationary pressures, and geopolitical risks are escalating in ways that rattle investor confidence. Against this backdrop, gold continues to function as both a hedge and a psychological safe haven. While newer digital assets like Bitcoin have attracted attention as modern gold, Chambers points out that physical gold remains unmatched in its simplicity and permanence. It cannot be diluted by political decisions, erased by technology failures, or undermined by trust in central intermediaries. This timeless reliability explains why gold inevitably draws capital when institutions appear fragile. However, Chambers is careful to stress that this enduring magnetism comes with its own risks. The instinctive rush toward gold, especially during turbulent periods, often leads to momentum-driven surges that can detach from fundamentals. Investors, carried by a mix of fear and excitement, can crowd into gold simultaneously, sparking the kind of volatility that makes professionals wary. In the long run, it represents the ultimate stability, but in the short run, its market dynamics can resemble speculative bubbles. Chambers emphasizes that discerning investors must navigate these psychological waves carefully, balancing gold's safe haven qualities with an awareness of herd-driven excess.
For AI to operate on the Chinese language is much more intensive energetically and on a compute basis than the English language. And if you want to look into your Shannon entropy, you'll see what I mean. So that actually gives America and Britain and anyone else that wants to speak English, I suppose India to an extent, an advantage over China, because China's going to have to do AI in Chinese and we'll be doing AI in English, which is a more compute compatible language structure, because there's only 26 characters, blah, 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 rather than the 2,400 characters of Chinese, and the actual entropy of the language in Chinese is much higher, which makes it more intensive for the computers to do AI in it. And that actually puts China at a big disadvantage. So if you see them suddenly saying we should be doing this in English, be worried, be very worried. Language models are language models. And if your language is highly entropic as opposed to low entropy, like English, you're going to have a harder time. And you heard that first here. You won't find that anywhere else in the literature, but that's kind of my gig is things like theoretical mathematics. But it's true.
Yeah,
it is true.
Yeah, no, absolutely. No, it makes a lot of sense. Zooming back out again, like there's a few more topics, of course, I want to touch with you on, and it's really like what you mentioned, or follow up what you mentioned earlier, is the US is trying to become a manufacturing hub again. Like, what are the odds, Clem? Like, if you were to assign a percentage, do they actually have a chance?
Well, sure, because we're in this disjuncture now, where it's not just getting a load of overweight Floridians to make Nike shoes. It's about robots and AI. And, that's going to be interesting, because ultimately what you're going to, okay, let's wind the clock back. Let's wind the clock back to 1690, okay? And there you are out there with your oxen. And by the way, you didn't use horses, you used cows. And you were plowing your field with cows, okay? And a stick with a pointy bit on it. And everybody lived on the land, and that's what they did. 95% of the people lived on the land, plowed the field, made food, and the extra food that they made, which wasn't that much, they would send to the cities, and the cities would buy it. And food was expensive, and people didn't live very long, and they starved, and children died. Okay, that was before the Industrial Revolution. Industrial Revolution came along. Within 100 years, everybody had left the fields. Well, maybe 150 years. Now, there's only 2.5% of people that are on the fields doing that job, and they're doing it. They go into these huge metal robotic things, and they go like transformers, and they plow the land. No, actually, it's called a tractor. But they use machines to make food, and everybody lives in the city and does the city things, right? And that was because they invented artificial muscle. Well, now they've invented artificial brain, and that's going to do the same thing to our society that artificial muscle did back then. It's going to change everything, and it's going to make everything incredibly bigger, and the numbers are going to add lots of zeros, and people are probably going to live to 95, and things are going to be wonderful. But everything will change, and they won't be doing in 150 years what they're doing now. It'd be completely different. And that wave is going to, whatever people do now that's repetitive and that a robot can do will be done. It's only things that robots can't do that people will do. And that's going to be a completely different economy. It's going to have much bigger numbers, because if you look at all the expensive stuff out there, take cars. The cars that everybody lost after, it cost £250,000. They're bright orange. They make a racket, and you can't drive them out of first gear without using your license. Yeah, or a handbag made out of $6 of leather that costs $7,000 because it's got some famous actor's name attached to it. And that's where we're going. We're going into a land of increasing value add. But, it will be robots that will be selling those handbags, and it won't be people. So now we're in that pivot point. So America can reindustrialize with robots and AI and vast amounts of automation, and can catch back up again. Yeah, because we're operating at a different level. It's not the old level of, hey, you got 1 billion people. Yeah, you build big factories wherever it does that all day long. Or anything that's a physical metal, particularly metals, is going to go ballistic. over the next, until further notice, right? Because AI is going to consume all that. Even silver, I mean, silver obviously is retail gold, and that's been driven by that. But copper, I keep coming back to copper because it's one of those things that kind of does my head in. 5 years ago, everyone was saying there's not going to be enough copper because of all the electrification. That was before AI, and AI would consume double that, triple that. Who knows how much multiple of that more? And there's still no more copper. At some point, copper is going to go absolutely ape. Now, you could say, well, you're just plain wrong. Well, how about this as substantiation? Anglo-American, one of the biggest mining companies in the world, established forever, has just agreed effectively to merge with the Canadian copper company. It's a bazillion, trillion, zillion, 40 billion. It's a massive value merger. It's one of the biggest mergers of all time to create the biggest copper producer the world's ever seen. So they've gone, oh, copper, we need to forget everything else. We just need to do copper. How do we do that? Oh, there's gigantic copper people over there, and they obviously know that's coming too. So let's merge with them, and they agree. So these two people that know absolutely totally inside when it comes to knowing about what's going to come with copper have decided to get together to make the number one copper company. So it's just like, it's like an insider trade being given to you on a plate. Yeah. So copper is not today because the market hasn't woken up to it. It's like, I remember talking to you about platinum when it was, and palladium when it was 900 only a few months ago. Now it's 1300. Yeah. It's one of them. And I go, duh, what am I missing here? There's not enough copper. Big miners are merging to create massive copper companies because they can see this juggernaut coming. And there was not enough of it to go around. It was a juggernaut coming before AI. And now AI is here. I mean, it's something like 50 million miles of cable that they needed before AI. Or you need to go look it up because it's all out there on the interwebs. And it stares me in the face and I go, whoa.
Looking ahead, the future of gold seems set to be shaped by a convergence of powerful forces: relentless government borrowing, weakening trust in fiat systems, and a world order that feels increasingly unstable. As currencies face steady erosion in purchasing power, the instinct to seek permanence will only grow stronger, and gold's role as a universal store of value will likely intensify. What makes this shift different from past cycles is the broader awareness among both institutions and individuals that systemic risks are no longer abstract but tangible, visible in everything from inflationary shocks to fractured geopolitics. In such an environment, the demand for assets that exist outside political and technological manipulation is poised to rise, and while price swings will remain part of the journey, the long-term trajectory points toward greater acceptance of gold, not just as a hedge, but as a core pillar of wealth preservation in a world of accelerating uncertainty. As inflation concerns linger and traditional assets face pressure, its appeal as a monetary hedge could strengthen, drawing in both cautious hedgers and speculative players. This combination of industrial and financial demand may create an environment where even moderate buying pressure triggers pronounced price movements, making silver a uniquely responsive asset in future markets. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.